Good morning, Hedgeye Nation. Welcome to another episode of Sector Head Spotlight. This week, we have the consumables team, which means you get the pleasure of two sector heads, two for one, double whammy, right, Daniel? So I've got Daniel here in the studio with me, and Howard's joining via the phone. He had a little bit of a power issue, so in very on brand for the restaurant sector head. He had been in Starbucks, but it was just getting a little too noisy. So he's in the car, but very, very glad you both are with me. So thank you very much, and excited to.
I don't think you wanted the Bob Marley music in the background.
Maybe,
Maybe you do.
maybe, yeah,
Maybe you do.
maybe
I
like
don't know. But
I know this isn't Bob Marley, but Three Little Birds is one of my son's favorite songs. He knows every word of it to it. But anyway, so this is our fourth episode or fourth session. We for those that are catching this for the first time, I've sat down with Brian McGough, sector head of retail, Andrew Friedman, sector head of communications, and the first show was with Tom Tobin, who runs our healthcare team. So, look for more of these sit downs with our sector heads and really just trying to get convey and relay to Hedgeye Nation a bit of their background, their process, what goes into their selection of companies that they cover on their coverage list, and then also just general themes that we should all be aware of as we head into both H1 2023 and the rest of the year. So with that, if you guys don't mind, maybe Howard, we can run it. Go to you. Some might not know that you were one of the first analysts that joined Hedgeye after the inception that was formed. And when I spoke with Brian last time, Howard, he kind of gave us the rundown in regards to how he and Keith and Bloom kind of came up with the concept of Hedgeye, and I know you joined shortly thereafter. So I'd love to, if you don't mind sharing a bit of that kind of story and your background there.
yeah, it's funny. Someone asked me this before. I tell the story because the AM call has been such um, a big influence on all of us over the past year. Brian, Todd, Keith, and I used to sit in Keith's office on Whitney Road in New Haven in four chairs. And Keith sat behind his desk. And that's how the call started. Like literally the four of us sitting around every morning telling, what we're seeing in the markets, just like we do today. It was four of us back then, but it's been a pretty remarkable run in these last 15 years. But prior to that, I, like Brian, worked at Morgan Stanley for 15 years, was covering a host of consumer names. I was the Latin American beverage analyst. I did tobacco, I did food, I did small companies, and I did the restaurant industry. So it was kind of a unique time, if you will, at Morgan Stanley, just because of in the hate to say it, the 90s, a long time ago. But that's how I got my start. I got my start, and I can say this now, but I didn't. I always thought, and I hold this true today, is I always thought my first and most important client were the portfolio managers and the people managing money, and not the investment banking team, which is probably why I left Morgan Stanley, because that's who we are today, and that's what we do. Like our job is to find stocks that are either going up or going down and going long or short. Like we're in the business to make people money, and you can fire us, institutional investors can fire us every quarter if they don't like what we're doing. But 15 years later, we're still in business and we love what we do. It's fun picking stocks. You could hear, Andrew this morning, getting better right today is it's a wonderful experience. It sucks when you get it wrong, and we all do get it wrong, but
Yeah.
that's just, the name of the game. So it's started day one with Brian, Todd and I, and, a little conference room in New Haven, and but doing the same thing effectively, just
Yeah.
with a little bigger audience today.
Yeah, that's awesome. And Daniel, when did you end up joining the consumables team?
Consumables team I started, I think, just a week before the pandemic
Okay.
shut us down here
Okay.
in Stanford. And then I joined Hedgeye a couple years before that. I was on Brian McGough's team.
Gotcha.
And before that, I think I had spent 15 to 16 years, not exactly sure, don't
Sure.
want to count, on the buy side, various hedge funds. And, interestingly enough, my background was I was one of the first, institutional clients. That's all we had at Hedgeye had at the time, right? Is institutional clients.
Right.
And I was one of the first group of funds to sign up for Hedgeye.
Oh,
So
very cool. So you've been,
I think Keith.
so he's been a Hedgeye groupie for quite a while, eh?
yeah.
I think Keith still has the. I think it's a $2 bill or a dollar bill that Daniel's boss gave him. I think when he was the first client.
That's awesome. I actually didn't know that. That's amazing. That's really cool. Well, perfect. Well, typically what we do next is sort of go through a bit of your process, or kind of your selection, and kind of how you comb through all the companies that are available to you in your universe. And so I don't know if you guys have preferences, kind of who goes first or what have you, but
Go ahead, Daniel.
if we want to go
Daniel,
consumer staples, and for those that aren't aware, staples are a great outperformer in quad 4, and that's currently the macro outlook. So I don't want to steal any of Daniel's thunder later, but if you're not paying attention, you should be. This is a key team to have in your Rolodex and in your back pocket here as we head into more quad 4s on the horizon.
Sure. So I'll tell you a little bit about how I use, Keith's quads and his process. So, I think like a lot of institutional clients, you're not all that quick to adopt other people's processes, right? So I would say that I was no different. I probably preceded the quads itself, but over time, I think when we lived through the financial crisis, that's really when funds who didn't have a macro process, and we didn't at my fund, we all had to. Anyone who survived had to integrate that. So we went from like having none, right? So everyone just reading strategists and economists notes by themselves to every Monday we divided up, what a macro strategist, when an economist would do. We divided it up. I would bring consumer things to the table. Every Monday we'd spend a couple hours, and I'd point out these things, like whether it's credit card debt or consumer spending patterns. And so I'd bring that to the table, and then the financial analyst would bring his, right? So, and then we'd have Keith come in, and Keith would sit with us and kind of go through like, oh, what, you're forgetting this one and that one. So that's how we integrated it in the process. And then when I joined Hedgeye, I used it even more, right? Being here firsthand.
Yeah.
And so in consumer staples, I think we do use it as a pretty good framework. And we also use the style factors. And so I look, the same thing as I've always done, though. I look from bottoms up, but I focus maybe more of my time depending on what quad we're in. And, I can move companies up and down our position monitor based on the style factors or what Keith's seeing. But so in consumer staples, where companies are pretty steady generally, right? They're quite visible. That's one of the benefits, right? Even in a pandemic, right? They still grew revenue, right? So you have all that visibility, but I do focus on companies with good organic growth prospects, where you really know where the top line is going to be, that it's going to be growing, right? So I generally don't have companies that don't have a very good organic growth prospect outside of what maybe the cycle part they're in, and then, I could do that for a trade, and I'll do that from time to time, but I'm generally looking for, like, I have some themes, and the themes change, right, over time, but then where those themes fit with Keith's macro process and his quads, that's when I'll get louder, make the positions larger, and so I think it's pretty integrated, and, within the position monitor, you can see elements of, like, at the very top of my list is Pepsi and General Mills, companies that Keith would probably pick right off. If we had no consumer staples analyst, maybe that's what Keith would point to. But then later, a little further down the list, in the pecking order, you'd see more of a smaller cap, which doesn't perform as well in quad 4, but has better growth prospects, where you need more of a bottoms-up analyst. And I think you can see that reflected in my positions.
Yeah, that's great, and I love that you stick with that macro Monday themes. Every Monday on the call, you go through more larger, bigger picture items, and at least in my opinion, whether it be recently the cold season, but generally, and so it makes a lot of sense. I just thought you did that naturally. I didn't realize that that's basically been baked into your process on Monday mornings for years.
Yeah.
In terms of taking the consumable side and tying that into the macro. I just thought you were really good at your job, Daniel. But it's
You get better if you survive.
yeah, I guess so, right? Which is awesome. And Howard. So again, I mean, you see please don't take this the wrong way, but seasoned vet, that's to me, that's a positive and a compliment. And Daniel's a seasoned vet too.
Thank you.
I think all three of us are kind of seasoned vets at this time. I'm 15 years into the business myself, so don't like the baby face, 38-year-old over here. So, but like how do you've got, restaurants is you've got a wide list, but it's sorry, like a large kind of pool to select from, especially globally, and where we have a go anywhere strategy. How do you kind of narrow it down to some of the ones that you cover?
Well, it depends whether they're going up or down or not.
Yeah, fair.
So that's so like Daniel, we start with a screen, right? We have, every ticker within our universe is, available to us. So we have our, factor screens that we put through all the names in, and, like Keith, we can push a button, we understand where they are. And so kind of depending on that, it leads us to different ideas, right? And, this is layering in the macro standpoint. I'll just go back to the first part of 2022, when we could see quad 4 coming, right? So we proactively prepared for quad 4 in January. It was a little early for McDonald's and some names, but the fact of the matter is you can see it coming, and, we were preparing for that. So we did. Now, to flip side, we're looking, I'm looking at, we're within 3 to 6 months of a shift, maybe to potentially quad 1, right? Or quad 2, kind of depending on what happens. So, I'm already looking down the road for those names, frankly, and you're seeing it to a degree in one of the latest names that we wrote on in the deck we did, which is Brinker, which is Chili's, and a rebound there. So it's early because it's casual dining. I'm bearish on casual dining, but I see, I see lights at the end of the tunnel for companies that's struggling and really will do well sort of at the end of the year, right? Not necessarily today, but if it goes down when the market's going to go down, if Keith's right and the market goes down again, as we got another downdraft coming, that's a name you want to be buying, frankly. And we're sort of already identifying that potential. But that being said, we start with a screen, we start with a factor screen, and then which sort of leads us to out of consensus calls, frankly. And if you look at sort of the, over the history, what I've done in the restaurant space, what Daniel's doing, and and to a degree across the board for the firm, is you want to find that out of consensus call and then make it early, right? You don't want to wait till after the quarter's reported. So, we've done that successfully in the past. We've not done it successfully, but that's when you make your most money. You buy into controversy. You understand the business model. You understand what's coming down the road. Hopefully, you understand what's factored in from a stock price standpoint. But if you look out 3 to 6 months down the road and things actually work the way you think they're going to work, you can make 30, 40, 50%, 60%. This is not a group where between Daniel's group and my group, where you're going to find 10 baggers all the time, right? That just doesn't work in our world. We have stable cash flow businesses. They're 1 to 2 to 3% comp growers or unit volume growers, a little bit of pricing, some margin, great cash flow, buy back stock, financial engineering, and you can get a good stock that way. That's why you want to buy into the controversy, and it works. It works well. It doesn't work every time, but I think understanding the controversy, and to a certain degree, Chili's, I'll go back to Chili's today, right? Chili's is a casual dining name. People hate it. It's been mismanaged for years. So what's to like about it, other than you have a new CEO who's making a new process, new changes, ultimately changing how they interact with the consumer. Its margins are way below industry average. There's no reason why it should be below industry average. It should be, industry average at least, maybe better than industry average, because it's a better than industry average chain. If that happens, you've got 50+% upside. So, it's early, but it's just, I don't know if that helps, Robert.
It does.
Sort of understanding how we think about names, but that's.
No, it absolutely does. It absolutely helps. And, so two things there. One, anecdotally, I ate at both the Texas Roadhouse and the Chili's this past weekend. Texas Roadhouse was excellent. Chili's was, I'd say, mediocre at best. My kids really enjoyed the sheet that they got, right? They create for the coloring and stuff.
What did you have at Chili's?
I had a Caesar salad, and it was basically limp.
Robert,
I know, dude. I
come
know.
on.
Even my wife
A
was like, "Why did you order
Caesar
a salad?"
salad at
I
Chili's?
know, I know. It was stupid, but it was Sunday night, and I was like, I just wanted
You
something
on
a
a
little bit
diet?
healthy. I'm not all a diet, but I'm 38, so you can't eat shit anymore, So it's like, but
You can have a hamburger.
I had a burger at Texas Roadhouse, and that thing was fire.
All right, so you got to go back and give
Yeah.
Chili's a try
No,
as a
no.
burger,
My
right?
wife liked she had like the fajita thing. It was very good. My kids like the mac and cheese, so it was all good. I chose very poorly, but good experience overall. Good experience, but in terms of pivoting to what we're really here to talk about, which is not my choice of restaurants over the weekend, is one of the slides that again for those at home, this is a team of three, so they've got an analyst Nick Balsh who's wonderful and they also cover cannabis as well. So this is literally, we've got restaurants, consumer staples, and cannabis is in terms of, what Howard just mentioned in regards to, really, if you're looking for that outsized, big, huge wins, I mean, cannabis would be the sector potentially on that mega tail duration, if you choose right to do that. But we don't need to get into cannabis today. But one of the slides that I did really love and would like to hear kind of how you guys use it in your decks or in presentations is slide 2, Genron, in regards to the consumer ETF process or performance, excuse me. So kind of combining both the global macro and some of those tickers along with some of the tickers inside of your universe. So I'll pass the puck over to y'all and kind of let you walk through kind of how you'd like your either institutional accounts or consumable pro guys to kind of take a look at this or review this.
You accurately described consumables, right? You consume it in the home, you consume it out of the home. It's our universe.
Yeah.
So anyway, but to the ETF performance, so going back to the screens I was talking about, right, and understanding what's happening in the market, and you can get this from Keith and the macro team, but this is just sort of our universe of, on the right hand side of that screen in the box on the upper right is sort of the consumable ETFs, right?
Yep.
That the big macro ETFs that we look at. The ones in green are the cannabis ETFs, or too many of them, but the other ones are sort of global consumer ETF performance. We'd like to understand, what's working and where it's working, in what region of the world. So we use this and we look at this every day just to understand, what's happening. On the left hand side, is the same thing you get from the macro and the Keith's team and the bigger, broader ETF. So
yeah, and Howard, one of the reasons why I wanted to share this is because I think this is a great overview. Like if you're creating a watch list at home, right? If you're creating a watch list, that's a great synopsis summary of, especially if you're focused on kind of the consumable space in regards to key ETFs, key big ETFs to be watching. And then from there, you can dive in and leverage your research, guys, to get the names inside of those ETFs that you really want to gain exposure to. And there's a lot of different ways of doing that. You can go, you can pair things off in terms of long some of the individual names, short the underlying industry kind of sector exposure. You can go vice versa, short, go long the general kind of like sector, short the individual names. You can also just go, don't have to pair trade at all. And we don't need to get into those dynamics, but that's one of the reasons why I really liked sharing that, because I thought it'd be really helpful for those at home to see that and to see kind of what a watch list would look like and something that you guys use all the time. So thank you for sharing that. We've got about 10 minutes here, guys. Maybe you want to touch base on some themes or that we should be paying attention to as we head into kind of post earnings here in folks are reporting Q4 and going into the first half of 23.
Sure.
And Genron, there is a slide 13, but
yeah, maybe we'll. I really like what you were talking about with the watch list, and I think that's appropriate. And like Howard said, we have to be a little bit early, right? Like if 100 people, I'm just making up a number, but if 100 people listen to one of Howard and our calls, probably only 10 to 15 are actually hearing it sort of live that day. So if, this isn't a real-time alerts product, right? Like, it takes a little time for the messaging to go out. Institutional clients have to vet it with their own process. Pro consumer, they're busy. They have jobs too. They might not be looking at it live. A lot of them watch things on replay, maybe even on the weekend. So we can't pick, an idea just for earnings for the week and
Right.
have it communicated enough, right? Like and it's almost like we're trying to get your attention on this, put it on your watch list, do some work, do a little more. We have plenty of, things in our archives about it, and then you can continue to do your work. But so maybe I'll just point out one today, for example. It just sort of makes a lot of sense. Is Lancaster Colony on slide 18. So this is one I just pitched this week on, our Hedgeye picks, right? So they reported earnings today. The shares are down, but nothing's really sort of changed in terms of. So this is like the buying opportunity. Like everything's sort of lining up. I think there's a little bit of confusion over what's considered non-GAAP or GAAP earnings, and I think the whole margin story is coming out. They didn't blow away numbers because egg prices sort of spiked on them, right? And egg prices aren't going to always be this high, right? You can't have a dozen eggs cost $10 for that long, right? Chickens are the shortest life cycle, right? To add capacity, that's the quickest thing in agriculture that you can add more capacity to. So it will correct, and so that little headwind will go away. But they just opened up a factory which has a little bit of gross margin dilution from not using the whole factory. When you add it on, you have to start now depreciating it once it's online, right? So if you're only using 1/10 of the factory, now you have 10%. You have so much more overhead costs for not a lot of production. So that's just going to get a lot better, but it looks worse right when you bring it online, right? And they added it just at the end of the quarter. So it's those types of things. But this is a company, the sort of going back on this, they have a lot of gross margins to catch up, probably more than almost anything in my space. And they also have this extra visibility, which I like. I know a lot of people know this company, LANC, but one of the things I like about it is that, they sell to about more than half of Howard's QSR companies. They sell the sauces to those companies. So you're participating in the growth that you're seeing in Howard's QSR companies. And one company in particular, Chick-fil-A, which I think is one of my favorite fast food restaurants. And, I think it's benefiting from, has one of the faster unit growth rates of a large chain, but also has, they're selling their sauces in grocery stores now. And that's where a lot of their growth is from. About, 24% of their sales are Chick-fil-A sauces to the restaurant or to people buying it at the grocery store.
Wow.
And they've been supply constrained. That's why they just opened up this new factory. It took, 2 years in the making to just open this up. And that's going to open up a lot more innovation, a lot more SKUs, a lot more size, a lot more inventory. It's been sort of supply constrained from that. And that, I think, is like the best way for a public investor to participate in the growth of Chick-fil-A. Because if you really like Chick-fil-A that much, and the only thing you can do is open up one, if you're lucky enough to get one, right?
Yeah.
And that's your 6-day-a-week job. This is a little bit easier.
Yeah.
You can still participate in the growth of Chick-fil-A, and you can just do it just by owning the shares. And so that's, that Chick-fil-A sales grew 30% for them last year. It's half of overall sales growth. So you have a lot of visibility there. And then you have the margin catch up with, the costs, came first, and now they're pricing for it. So you're going to have, 300-400 basis points of gross margins over the next 2 years with this, and you're going to see the top line sort of accelerate. Even adjusting for inflation, you're going to see that top line accelerate as they open up this new capacity.
Awesome. Do you get much pushback on revenue concentration in terms of kind of having Chick-fil-A being 20%?
Well, I think I haven't got any pushback. I think if anyone would think that, they would probably want more Chick-fil-A exposure than less. Like Chick-fil-A, I mean, I'm going to pass.
I don't disagree, but yeah.
I'm going to pass this one over to Howard. And what you think? Howard's probably doesn't get too many questions on it because Chick-fil-A is private. But Howard, where would you bet on Chick-fil-A versus other QSRs?
So for those at home, that's Lima Alpha. Lima Alpha November Charlie. That's LANC.
So what's the question, Daniel? About
just in terms of revenue mix, right? So I just was questioning whether or not people were pushing back at all in terms of revenue mix being a little bit more heavily skewed to Chick-fil-A versus anything else, just from a company standpoint. But the answer
it's an exceptional business. It really is. It's unprecedented actually in the restaurant space. So I've said this before, but just to give you an example how successful they are, Chick-fil-A does more in 6 days in sales than McDonald's does in 7.
Holy shit.
Yeah. McDonald's is by far the number one.
Yeah.
So yeah, I mean, it's on an annual basis. So Chick-fil-A is open 6 days a week, not 7, right?
Right. Yeah, because they're
So
closed on Sundays.
Chick-fil-A
I can't
does
tell you the number of times
more
I've been driving
in
home.
annual sales.
Yeah, sorry, go ahead. The more in annual sales, yeah.
Yeah, no, they do more in annual sales in 6 days a week than McDonald's does in 7. It's an extraordinary concept. So I would think that Lancaster shareholders would want more exposure to Chick-fil-A, not less.
Sure, sure. And then in terms of your earnings season right now, Howard, what have been some kind of themes that you've seen either that management's either kind of talking less about as we kind of at the end of 2022 and or kind of guiding towards or warning towards in 2023 here?
Yeah, we got 2 companies, unfortunately, so limited pool for what to talk about. But
Mickey D's was one of them, right?
The themes for both of them were inflation, especially on the food side, is staying elevated, and for McDonald's, Europe more than the U.S. And for McDonald's, inflation is not just food, but it's also across the board. I was surprised to hear Brinker say that their labor costs were only up 5%. So so their food costs were up, I think, 18%. So food cost inflation is still rampant here in the first half of 2023. Will mitigate into the second half of the year. Labor costs are already starting to come down for a lot of companies. Those are the 2 big themes. And pricing is going to begin to slow in the second half of next year as well. So the question really becomes is what happens as pricing comes down, what happens to transactions in the space? And that'll be interesting to watch as we head through the balance of this year. We do have Starbucks after the close today. So we'll see how China did for them, but that stock, it's a short for us. The stock's been ripping on the China play. But understandably why people are buying that or, want to play that game. We're long Yum China for the same reason. But Starbucks is it's 2/3 a U.S. business or North America for the most part. So yes, it is a China play, but it doesn't drive, the overall performance of the company. So we'll see. So awesome. I'm hedging on my short. I'm not hedging on my short at Starbucks because I really don't think the CEO is the new CEO, which hopefully you might hear from him today on the call, but we'll have to see. But anyway.
Yeah, I mean it's about portfolio construction, right? Howard, you can be it's a 2-to-1 ratio typically. At least that's what Keith's coach preaches, and so you can be long a little bit of YUMC and short a little bit of SBUCs, and it should offset. The China exposure should get offset one way or the other, and then if you get the fundamental story and the true story, right, which is growth slowing within SBUCs, then you get hopefully you get double whammy there, right? You get YUMC outperformance and Starbucks,
and we're doing that. Yeah, we're doing that in the casual dining space. It just happens to work out this way. It's not planned this way, but we did a long deck on Chili's, Brinker, EAT, and then tomorrow we're going to go through the short thesis on Dine, DIN, which is Applebee, which is so Chili's and Applebee's go head to head one the other, and it'll be. I find it interesting that the way these CEOs are managing their businesses are very different for effectively very large mature chains that need to focus on the 4-wall experience and not growing, and one's focused on growing and the other one's focused on the 4-wall experience. So you drive better returns and better shareholder value when you're getting the most within your 4 walls and the better profitability within your 4 walls than trying to grow aimlessly and not focusing on profitability.
Awesome. Yeah, so for those at home, if you can't tell, we're just scratching the surface with these two. I feel like there's just, we could have multiple of these conversations, and again, just so if you're interested in learning more, obviously you've got the Consumables Pro, Sector Pro package. And then if, you know, from an institutional standpoint, if you're an institutional subscriber, by all means, kind of reach out to the sales team. But, you know, I want to thank you both for sitting down with me today. I'm excited to do it again very soon and dive even
Next week?
deeper. Absolutely. Yeah. Next week. Right. Yeah. And you're getting in the studio more frequently too, which is awesome to see. So I'm for Chalk Talk, and that's yeah. So keep an eye on that. They're always improving their process. Yeah, go ahead.
Yeah, no, I was gonna say we introduced that last week, and just so you know, Daniel, Nick, and I, we get together every week, or we try to get together every week and talk anyway about, you know, administrative issues, things we have to deal with, but we all talk about ideas, like, and you know what the calendar looks like, and banter around good ideas, bad ideas. You know, is this a short? Is this a long? So we're actually, what we've done is, obviously don't want to talk about the administrative piece, but the piece that when we talk about ideas and we talk about what's going on in, you know, what happened this week, you know, we'll talk about McDonald's and Brinker and, you know, Starbucks. And so we just recap what happened and then talk about the ideas and changes to to our position monitor. We're now taping that and making that piece of our conversation, which we've been doing for years anyway, making that live for everybody, or making that not live, but
yeah,
recording that.
Yeah, it's
recording
awesome.
that.
Yeah, it's awesome.
Provide the Pro.
No, absolutely. I think it's a great idea, and hopefully more will do that, because it's awesome to be able to just deliver that product, and one I would think saves you guys a little bit of time too, from like rehashing or typing up exactly what you're talking about, right? So it's good for everybody, which is a good thing. But again, thank you both very much for sitting down with me, and for those at home, thank you for joining in. We'll be back next week with REIT Rob, so we'll be covering REITs Thursday, 11:30. Weekly Notebook Review was last night or yesterday afternoon at 4:30. We've got a beginner's guide tomorrow at 11:30 back here in the arena. Tune in for all those. You can catch the replay of Weekly Notebook Review, Hedgeye YouTube, on any of the podcast channels, and obviously on Twitter Spaces as well. With that, I bid you adieu, and thank you again.